You're a pro at getting water.
That's right.
Hey everyone, it's Rachel here with your Tech Talk Tuesday from MarketEdge.com. With me as usual is our favorite David Blake. David, how are you today?
I'm doing well, Rachel. Thank you.
Great. You want to give us a look into last week's market letter and what's going on this week?
Yeah, we had another up week last week. The major averages started out the period of trading mixed. I think that investors were a little bit cautious ahead of this week's inflation reports and FOMC meeting, which concludes tomorrow with the Fed announcing what they're going to do with rates. As of today, with the CPI number that came out, the CME group, FedWatch, is expected about 93% probability that the Fed will pause on their rate hike. So we're actually getting another night, a second day of a rally here today. Now on Thursday, we did get the initial jobless claims came out last week. They jumped 28,000 to 261,000. That was we were just remember just a couple of weeks ago we were trying to get them up over 200,000. So we're starting to see an increase in that. Yields initially came lower, but then 261 isn't too bad. And we had the unemployment rate went from 3.4% to 3.7%, and then analysts started saying, that's still a pretty good jobs market out there, and perhaps we can still maybe sidestep a recession, and then that caused yields to tick up a little bit higher. We ended up with a 10-year Treasury on Friday at about 374. The two-year T-bill ended around 4.6. We did see for a second week something that we've been talking about on these little tech talks, and that is we saw the underlying breadth expand last week. We also saw an outperformance by the small cap Russell 2000 and the Dow Jones Transports, and that bodes well for the market going forward. As we say a lot of times on these letters, we'd like to see some of the secondary markets, including the semiconductor index, outperform on the way up, and generally they're going to underperform on the way down. So that was something that we wanted to see, and we're starting to get that. I think the only sectors that closed in the red, surprisingly, consumer staples, which is defensive, but also technology had a small loss last week, which is surprising because the last 2 days of the week we did see the big cap tech stocks take the lead again. They had some pretty good moves, but for the week it was actually almost flat, but down just a little bit. Now, as far as what outperformed last week, we had the consumer discretionary sector. We had energy, utilities, industrials, and financials, which is a little bit more cyclical type sectors, which is also what we want to see. They were the top of the leaderboard. It's surprising that energy was one of the stronger sectors last week because we had a jump in oil to start the week. It was OPEC plus members had a meeting over the previous weekend, and they decided they were going to cut production by 1 million barrels a day, and that caused oil to jump up a little bit. But then towards the end of the week, it was flirting with $70 again. And actually, yesterday we saw it. It fell down to, I think, the lowest. Yeah, it was the lowest since December of 2021. It fell yesterday 4%, and that was down to $67.10 a barrel. So we had a big drop yesterday. Part of that again was, or not part of it. The main thing about that was that China's reopening seems to be weaker than anticipated. Now today, if you're following the oil prices, and energy is one of the stronger sectors today, the central bank in China cut short-term rates to try to boost their economy a little bit. That helped the Asian markets tick higher today. Japan made a new high. I think some of the other Asian markets are also hitting all-time highs. So that's something to watch if we can see if China gets their economy going a little bit. So we did see another bump up in oil today. We'll see if it holds. A lot of people still think that China's reopening is going to remain weak, but we'll see. Anyway, so we had some choppy trading, to start the week, and then finished on a high note. The NASDAQ extended its weekly win streak to 7. That's the longest streak of gains since November 2019. So, and of course, a lot of that's due to the big moves in the Apples and the Microsofts and Tesla. In fact, Tesla was up again today. It's gonna be up for the 13th day in a row. That's phenomenal. I think yesterday we were talking about it. That's the most overbought stock in the S&P 500. But they've had a lot of news. I think it was last week they came out where they're going, or GM and Ford are going to use Tesla's charging stations. Tesla will get a lot of money from that, also from tax credits and clean air credits, carbon credits, I think they call it. So that was good news for that stock. We also had the S&P 500 close higher for a fourth consecutive week. The Dow played a little bit of catch-up ball, and it was up for a second week. Okay, the technical condition of the market did improve somewhat last week. Not great, but we just saw the technical indicators move up a little bit. They're bullish. They moved up a little bit higher. The momentum is measured by the 14-day RSI is strong. MACD shows the short-term and the longer-term trends are both bullish right now. But we did end up with the NASDAQ 100, and Philadelphia Semiconductor Index. They're still overbought. I said the week before, which I guess was 2 weeks ago, whatever, that they were the most overbought that they'd been since November 2021. And last week's churning back and forth worked off some of that, but yesterday and today they're back into overbought territory. I want to look at some of those charts maybe later on. We do talk sometimes about Fibonacci retracements. The S&P 500 crawled out of its bear market last Thursday. That means it's some people will say that's entered into a new bull market. I'm just going to say that we're 20% off the October 22 low, and that means that we're out of a bear market. Anything above 42.95 got us out of the bear market, and we've had a couple of nice days. We're having another nice day in the S&P right now. We're at 43.65, so it's picked up almost 100 points in just the last couple of days. That's a nice move in that. NASDAQ has retraced 50% of its bear market sell-off, and I said in Friday's letter that 61.8 Fibonacci retracement for the NASDAQ would target 13.9 for the NASDAQ. Today we're at 13.550, so we're getting close to that level. And for the Dow Jones, it had hit the 61.8% retracement earlier. It had a pretty fast move off the October low, and that would target 33.9, 33.950. And yesterday and today, the Dow Jones is right now at 34 and 34.2. So they're breaking that out. I would point out that once you see that 61.8% retracement level broken, whether it's going up or down, normally you're going to get a retracement of the whole move. So that's indicating that perhaps we can make a run, back to the all-time highs. We'll have to see. As of yesterday's close and what we're doing today, the NASDAQ and the S&P 500 are at 14-month highs, which takes it back to April of 2022. So the things are looking good. The fact that we're seeing some broadening out of the underlying breadth is a big positive for the market. We had an awful lot of up moves with just 7 to 10 high-tech stocks. That's not a rally that's sustainable. You need to have that spread out, despite the weightedness of those companies. The fact that we can now start to see more cyclical stocks participate, that's what we want to see if this market's going to have legs and maybe making a run back to its old highs. I'm not sure it'll be able to do that, but we'll see. We also have some of the different sectors making new 52-week highs. That include the communication services sector, consumer discretionary. The consumer discretionary, a lot of that comes from Tesla and also Netflix. They're the two heaviest weighted stocks in that sector. And of course, they've been on fire lately. So that's why that one's making new 52-week highs. And of course, the technology sector also is at a new high. So that's good. We also have the industrial sector close to making a new 52-week high. I'd like to see that happen. That would be good for the broader market. We also, last week, we saw a pretty good jump of investors' sentiment towards the bull camp. The retail investor, which we look at the American Association of Individual Investors, the AII, they saw the retail bulls jump to 44.5%, and that was the first time that the bulls have topped the bears since mid-February. Now that was when the market last topped out, which we're going through that now. So when these numbers get to be towards their extreme level, that's not at an extreme level by any means. So the retail investor is still going to come on here with add more to the bullish camp. But we also saw, which was kind of strange, we saw a big jump in the National Association of Active Investment Managers Exposure Index. It went from 53.9% the prior week all the way up to 90.1%. That big of a move is a bit extreme. That obviously shows that they think that that probably we're going to get a pause here, and the market may have more room to go. I mentioned earlier that as of today, there's a 93% probability that the Fed will pause on the rate hikes. Surprisingly, though, even today, in July, 62% of the Fed watch people are looking for at least another quarter rate hike, which is a little bit surprising. I think that'll depend on how the data comes in. They're going to be data dependent. I think that they're thinking that with the start of the summer, they're going to maybe get the consumer out here spending a little bit more. There are some things that I've read that you want to watch out that may hurt a little bit of the consumer, like when you look at some of these downgrades to Costco and TJ Maxx, that type of thing. And part of that is that we're getting ready to implement student loan payoffs again. So I think that analysts are thinking that's going to cut into, especially stores like Walmart and Target, that type of thing, maybe even Costco, that when people start having to pay back those loans, that they'll be spending a little bit less, and they've cut down retail spending a little bit in here. Okay, well, last week that this week was probably going to be a turning point for the market. We are going to get the May read on CPI, which today came in right in line. You usually don't have it exactly in line, but for the core CPI, which is what the Fed looks at a little bit more. Let's see. Okay, the core was up 0.4% and 5.3% year over year, while the May CPI, the regular read, including the food and energy, was up 0.1% and up 4% year over year. That's down from 4.9% in April. So the Fed will look at that as some pretty good progress. As far as the core CPI, I think that came from 5.7 or 8 down to 5.3. Not quite as strong on that, but still enough that the Fed's going to pause. I think what you'll hear tomorrow is in the announcement. I think you'll see or you'll hear Fed Chair Powell say that we're going to be data dependent. Just because we pause here, that doesn't mean that we're going to stop for the year. I think they're going to say that if things kind of flatten out on the inflation numbers, that they could probably raise another quarter or maybe do a half and see if that stops it. So we'll have to see on that. I think the market is expecting that. The problem again is how sticky the inflation remains, and we also want to see what the jobs report is this week. The jobs report is kind of a funny thing, because if it comes in too hot, which means also we see a drop in it, where maybe it dropped down to we only have 220,000 initial jobless claims. That's going to be that would mean that we're going to sidestep a recession to send stocks up higher. You get a jump up maybe to 300,000 or 290 or something like that, and that means that maybe we see the Fed pause a little bit longer, and that could cause stocks to go up. So I think you want to focus right now more on the on what the inflation reports are going to be. And again, tomorrow morning we get the PPI. I think they're expecting the PPI is actually for the regular PPI. I think I saw this morning it could actually go down 0.1%. and then the core PPI I think was going to go up like 0.3%. So the numbers are, we're seeing progress on the inflation front, and we want to see how that goes. I did want to end up with saying that momentum in the market remains strong, but I would advise that we may want to, I don't think I'd be wanting to chase the market in here too much. I mean, we're seeing a nice big bounce today and yesterday. We're getting a little bit more of a bounce than I thought. I thought it was kind of already priced in that the Fed was going to probably pause, but last night we got a good numbers from Oracle. That's helping the tech stocks today, also the semiconductors, and we'll have to see what happens. But there's a chance that if they do announce a pause, but then leave it open, that they could raise things later on in the year. If you get an initial pop, it would not surprise me at all to see the professionals sell the rally. The fact that the market's moved up here the last 4 days so much. So I would be cautious in here, but the fact that the underlying breadth is broadening out is good for the market. We'd like to see the leadership expand where we see the Russell small caps go. That they're strong today. They're up 1%, which is good. They outperformed last week, and that's what you want to see if the market's going to work its way up higher.
Great. So tomorrow, as you alluded to, we get the Fed's decision on the course of rate hikes, and the consensus is that we'll get a pause. Will that trigger another leg up for the market, or should investors remain cautious?
Well, again, the Fed wants to stay data dependent, and I think that they're going to pause, and I think what the consensus is they're going to pause and then leave it open data dependent. But the problem with this is, let's go to the charts for a minute, and let's start out with QQQ. Okay, so you can see down here. First of all, look at the RSI on this. Right now, at the close yesterday, we were at 73.62. That is the highest that has been on these charts. Well, let's see what this is. Okay, that's the highest that has been. Go ahead and pull the chart out. Let's go back, see if we can go back to the beginning of 2021. And you're going to see that that's pretty much the highest since going right 2021. The NASDAQ and NASDAQ 100 peaked in November, I think, of 2021. And at that point, the RSI got up around 75, 76. And right now we're at 73, 74. As you can see, it's been years since that index has been this overbought. And that should give you a little bit of pause just in the sustainability of this thing. I mean, markets don't just go straight up forever. There's always going to be some backing and filling that they're going to have to do. And I think at this point, I'm not saying to sell, but I would be thinking about possibly, if you're a trader, you're maybe taking some cash off the table, or at least putting some defensive positions in there. The stochastics right now on the QQQ is at 90, 97, 98, and it only goes up to 100. Last time it was that overbought on that was back in at the peak in July 2021. And stochastics just measure where the thing is trading on a range, and when you get anything over 80, it's considered overbought. Although they can stay overbought for a long time, as you can see on this thing, it's been overbought since where we get up almost to 100. We got up in the high 90s in March, so this thing's been overbought since then. It'll stay overbought. But I think it's time that as we take out this February 2022 high on the QQQ and also the NASDAQ, that you have to think about, okay, is everything built into this market right now? And I think you would see that it has to. Now, I would say another thing that you can look at besides stochastics and the RSI for what's overbought. We at MarketEdge, you have the opportunity to buy the MarketEdge S&P short range oscillator. Now, this is something that you can only get through MarketEdge. And this has been around for years and years and years. It's basically an institutional product, and this takes into consideration, whether the market is overbought, whether it's oversold. Historically, once it gets up around 5%, you do start to see some of the professionals begin to put on some defensive positions. When it gets up around 7%, which we've seen several times, normally you can almost bet that we're going to see, the pros especially take some money off the table and wait for this thing to pull back. As of yesterday, we were only at 4%. Now, I've had some people call in here, send me emails, and they'll say, "Hey, the NASDAQ's up 7%, or 7 weeks in a row, 8 weeks in a row now. Why is this thing staying around 1, 2, 3%?" And that's what makes this thing such a valuable tool. The reason the SRO is not up, at 5, 6, 7% with these things so overbought by other indices is the fact that breadth has been weak. If we were making these runs and you were seeing advanced decline lines that say 3,000 advancers and 500 decliners, then you would see this thing up maybe even 8 or 9%. But the fact that you have that the breadth in some cases has been flat to even negative on some of these up days, that has kept the SRO saying, well, the overall market is not completely overbought. The fact that some of these other oscillators are showing that the market's overbought because of just the price. They look at mainly the numbers and say, okay, this thing's gone from 100 to 110. That's more overbought. But the fact that it's been such a narrow rally, if you are a subscriber and you're wondering how in the hell is this thing not showing me that I should be getting out, it's because of the underlying breadth that it looks at and how the moving averages, how far the different indexes are coming off of the moving averages, that type of thing. Now, as we broaden out, you'll start to see this thing move up pretty rapidly. If you're not a subscriber to this, I actually think this is probably a really good time if you want to try it out, because as we see, if we see this thing broaden out, if we get another rally off of the Fed pausing tomorrow, then all of a sudden you might see this thing, take off, and that's when you're going to say, well, can we keep going? What are we going to do? And then if you look at the SRO and you see it pushing 7%, you'll know that okay, that's about as far as this run's going to go. Another thing I'd like to mention that if you watch Fast Money, you hear Jim Cramer talk about this all the time. He's a big believer in this thing. He uses this all the time, and he references it often on his show when things are getting a little bit frothy. But I did want to just mention, because I know that the signals on this have not, for as strong as the market's been, you haven't been getting the signals, and it's because, which is a good thing for you if you are a subscriber, it's the fact that underlying breadth has been, not matching the rise in the indexes. That's why this thing is telling you that, hey, we're moving up, but the broader market's not overbought, and we probably still have a little bit of upside. So that would be something if you can look at. Rachel may want to tell you how to subscribe to that if you're not a subscriber to that. Do you have a minute, Rachel, to go over that? Maybe show them the site where they can find this.
Absolutely. So if you guys want to go to marketedge.com and sign up here, you are able to sign up for MarketEdge or for MarketEdge and the S&P oscillator together for a discount. If you are more interested just in the oscillator, you can go to sposcillator.com, and that will give you either the monthly or annual options. So if you want to subscribe now, we have a limited time offer, 10% off on both the monthly and annual deals for the S&P oscillator. And what you'll get is an email every night straight to your inbox, letting you know if the market is overbought or oversold. Right when you get started with us, we will let you know some history on the product and how to use it. If you ever have any questions about it, feel free to reach out to our support They're here for you all the time and ready to help you understand how to use this tool to make the best trades possible.
Like Kramer said, it's a tool especially if you're active in the market, it can keep you out of trouble. I know, one of the problems, especially in the retail side, is when the market's going up, you want to be buying more, and this will tell you at a certain level that, hey, this thing's running about as far as it's going to go without pulling back, and you're probably going to have an opportunity to buy stocks at a different, at a lower level. So that's all I have for today.
Great. Well, thank you so much, David. If any of our listeners would like to try MarketEdge, your first 2 weeks are free at marketedge.com. And if you want to try the S&P Oscillator, you can do so with a 10% discount at sposcillator.com. If you have any questions for David or anyone on our support team, feel free to reach out using that chat box in the lower right-hand corner of the marketedge.com website. Otherwise, we'll see you guys next week. Thanks so much.